You catch the perfect New York Open reversal on gold. The setup is textbook, volume is surging, and the macro trend is on your side. But right before the trade moves 200 pips in your favor, a standard 60-pip retracement triggers your daily drawdown limit. Your account is terminated before the payout even materializes.
Act volatility breathing room the gold market demands. The metric that dictates whether you survive a prop firm challenge is ADR. ADR stands for Average Daily Range, which measures the typical pip movement of an asset over a single trading day. This chart shows why generic rules fail. On the left, a pair like Euro Great British Pound might crawl through 40 to 60 pips in a day. On the right, XAUUSD. Now look what happens when a standard 5% daily drawdown limit intersects with gold's natural movement. The rigid threshold cuts right through the asset's normal daily activity. If you are trading a $100,000 account with a $5,000 daily limit and you enter a 5-lot position, the math works against you. A completely standard 100-pip intraday fluctuation on gold instantly breaches that 5% allowance, terminating your account. Using fixed lot sizes without calculating a percentage-based buffer for market noise mathematically guarantees that routine price fluctuations will result in account failure. The most critical line item you must verify in any prop firm's terms of service is their daily drawdown calculation method. Many firms enforce equity-based drawdown. This means the firm tracks your unrealized floating profit and loss in real time, pulling your loss limit higher as your trade moves into profit. On the left side of this matrix, you can see equity-based drawdown in action. A trader is up $4,000 in floating profit. A volatile gold wick retraces the price downward, and because the limit trailed the profit peak, the account fails immediately. But look at the right side. This is balance-based drawdown. Here, the daily limit is calculated strictly from your starting balance at midnight, entirely ignoring those temporary floating profit spikes. This static calculation structure gives your gold trades the necessary mechanical room to absorb deep retracements and test entries without artificially blowing the account. Firms like FTMO and specific programs within the fivers provide this balance-based calculation as a standard feature. For a volatile asset like gold that frequently wicks back to original entry prices, an equity-based limit will kill profitable setups. Balance-based drawdown is a non-negotiable requirement. Beyond overt rules, high-frequency scalping relies on surviving the invisible mechanics of the market, spreads and execution slippage during high-volume transitions. Top-tier firms maintain raw spreads of 10 to 15 points on gold. Lower-tier competitors regularly see those exact same spreads blow out to 30 or 40 points during the critical London and New York session overlap. This blowout happens because lower-tier firms often utilize B-book broker feeds.
A B-book broker acts as the market maker and takes the other side of your trade internally, rather than routing it to external liquidity providers, which inevitably leads to execution lag. This chart shows the financial bleed. If you suffer just 3 points of slippage on a 10-lot gold scalp, you lose $60 per trade. Over 20 trades, $1,200 of your profit evaporates before you even factor in commissions. Without access to Tier 1 prime of prime liquidity, the invisible costs of poor execution mathematically erode a scalper's edge, trade by trade. These restrictions hit specific strategies harder than others, particularly smart money concepts. SMC is a trading methodology that attempts to track institutional order flow, relying on extremely tight 10 to 20 pip stop losses to generate high reward to risk ratios. To correctly risk 1% of a total account using a stop loss that tight, an SMC trader has to open significantly larger lot sizes. But prop firms often lay a trap by heavily restricting leverage on metals to 120, even while offering 100 on standard Forex pairs. This gauge illustrates the margin impact. At 120 leverage, executing a required 5-lot gold position instantly locks up roughly $50,000 of your available margin on a 100K account. Committing half your available margin to a single setup prevents you from executing multiple trades simultaneously or scaling into winning positions. While low leverage prevents beginners from blowing accounts, it actively neutralizes advanced SMC strategies. Professional gold traders must specifically vet firms to ensure they maintain 100 leverage on metals.
Navigating these variables means there is no universally perfect firm. This flowchart breaks down how to match specific prop firm rule structures to your exact trading timeframe. If you are a high-frequency SMC scalper, your primary match is the fivers. They provide the crucial combination of balance-based drawdown limits and high-leverage options specifically for metals, giving your tight setups the margin they need to operate. If your profile is a macro news trader, the data points to the FTMO swing account. The FTMO swing account explicitly removes the standard 2-minute news trading restrictions. This allows you to hold positions through massive volatility spikes driven by the CPI and NFP. The CPI and NFP are the Consumer Price Index and non-farm payrolls, two of the most violently traded economic reports each month. However, having permission to hold through the news does not protect you from spread widening. You still have to analyze retail sentiment data to ensure you aren't swept up in a stop-loss hunt right before the actual expansion occurs. Categorizing your specific strategy first allows you to navigate the complex web of legal parameters and avoid firms that structurally penalize your trading style. Finally, there is a third profile, the independent trader who has entirely outgrown strict consistency rules and prop firm constraints. For this profile, the alternative is utilizing direct capital through platforms like NX1, accessing zero-pip spreads and institutional feeds without navigating arbitrary daily drawdown thresholds. The trade-off is straightforward. You accept 100% of the personal financial risk, but in exchange, you retain 100% of the massive payouts generated by gold's volatility. To bridge the math gap between your current strategy and your firm's limits, use the FXNX risk calculator linked in the description below. Long-term success on XAUUSD requires an ecosystem that respects, rather than punishes, the market's violent reality. Establishing a partnership with the right capital model is the only way to turn that volatility into a sustainable edge.